You saw the headline and your brain did what it's trained to do. It grabbed the simplest villain. China is about to dump gold and silver. Sounds clean, sounds secret, sounds like someone somewhere knows something you don't. But what got dumped in the last 48 hours around the end of January 2026 wasn't a Chinese stockpile. It was the market's ability to breathe. Gold slid roughly 9% off the peak. Silver got hit around 26 to 27%, and the speed of it tells you everything. This wasn't a decision, it was an ejection. Here's the uncomfortable part. When prices snap like that, people don't look for mechanics first. They look for a culprit. China is a perfect culprit because it carries weight. Geopolitics, supply chains, leverage, fear. But markets don't always fall because someone sold. Sometimes they fall because too many people tried to leave. Through the same door at the same time, the sell button becomes contagious, and then it becomes automatic. And once it turns automatic, nobody is in control anymore. Risk limits are. A year of climbing prices quietly rewires behavior. The trade stops feeling like a trade and starts feeling like a shelter. Funds lean in, retail leans in, headlines lean in. Everyone tells each other it's protection, except protection can turn into crowding, and crowding turns into fragility. The safety story becomes the risk story, just with a nicer label. That is the first twist people miss. The more safe an asset becomes in the narrative, the more dangerous it becomes when everyone owns it at once. So let's cut the language in half. Dumping is a choice. It's deliberate supply, a planned unload, an actor with intent. Forced selling is different. Forced selling is a margin system clearing its throat and then taking the microphone. It doesn't care about your thesis. It doesn't care about China. It doesn't care what you believe the metal should be worth. It sells because it must. And when enough forced selling stacks up, price stops being a debate and starts being a stampede. Picture a theater. The movie is calm, the crowd is comfortable, and then someone yells fire. It doesn't even matter if there's a fire. What matters is that everyone stands up together. The exit door hasn't changed, but suddenly it's too small. That's liquidity. Not what you own, but whether you can get out without crushing the person in front of you. Try to think about this for a second. If two assets drop in the same panic, the one with the thinner exit is the one that falls like an elevator cable. That's why silver often looks crazier than gold, because the room is smaller and the shove is the same. Now we're inside the real engine, the loop. Volatility spikes, brokers demand more margin, risk teams tighten limits, stops get triggered, and positions get liquidated. That liquidation pushes price lower, which creates more volatility, which creates more margin pressure. It's a self-feeding machine, and once it starts, it doesn't need news to continue. It feeds on positioning. It feeds on leverage. It feeds on the simple fact that when you're forced to sell, you don't negotiate, you comply. Here's one practical angle I wish more people heard before the screen turns red. In leveraged markets, survival is a strategy. Size positions so one bad day doesn't own your account, and treat liquidity like a feature you pay for, not a luxury you assume. That isn't fear. It's hygiene, because the market's favorite trick is making you feel safest right before it tests how fragile you are. And this is where the China dump story sneaks in, not at the beginning, but after the damage is done. When price breaks, the human brain panics, and panic demands a story that fits in one sentence. China dumped. Easy to say, easy to share, hard to verify. The narrative arrives like a bandage, not like a diagnosis. That's the second twist. Sometimes the headline is not the cause of the move. Sometimes the headline is what people use to justify the move they already made. Take a breath with me for a moment. Slow down. Look at the shape of the fall, not the drama of the rumor. Look at the speed, the gaps, the way price behaves when everyone is trying to exit at once. One disclaimer, because this matters. Markets and geopolitics are multi-layered systems, and any single story that claims one simple cause is usually leaving out the mechanism that actually did the work. Okay, now speed back up, because here's the test that cuts through the noise. If China truly wanted to use silver, would they drive a truck full of metal into the market and smash the price? Or would they control the faucet that feeds the rest of the world? That second option is quieter, slower, and strategically cleaner. And right on the calendar, there has been talk of licensing export permissions that can tighten or loosen the flow starting at the beginning of 2026. That doesn't look like dumping, that looks like becoming the gatekeeper. If there's a China lever in silver, it behaves more like a valve than a fire sale. Now zoom out. To gold, because this is where the story really starts to wobble. If the accusation is China is dumping, you'd expect signs of retreat, less accumulation, less official appetite, a shift away from stockpiling. But the recent public data narrative has pointed the other way. Continued accumulation streaks, continued signaling that gold is still treated as strategic ballast. So the villain in the viral headline starts to look like the wrong character. The alleged arsonist is standing there holding a stack of fire extinguishers while the building burns for a completely different reason, and the stakes are bigger than a bad day on a chart. Silver isn't just a metal. It's an industrial artery, solar panels, electronics, manufacturing inputs that don't pause because traders got spooked. Gold isn't just jewelry. It's a confidence instrument countries and institutions use when they don't trust each other. Try to think about this. A liquidity crash can be a financial event today and a supply chain story tomorrow if policy tightening turns the faucet even slightly. That's where geopolitics stops being a backdrop and becomes a lever. So if you're Still holding on to the China dump story, I get it, I really do. It's neat. It feels like you've decoded the room. But neat stories are what algorithms love, not what reality runs on. The market doesn't reward the cleanest narrative. It rewards the most accurate mechanism, and the mechanism here is whispering something colder. When too many people pile into the same safe trade, safety becomes a crowded bridge, and crowded bridges don't break slowly. In the next beat, I'm going to give you a 3-signal checklist that takes any future China dump headline and interrogates it in under a minute. Because once you see what actually flips the switch from normal selling to forced selling, you'll realize the scariest part isn't China. It's how quickly the exit disappears and how calmly the system sells you out the moment it does. So let's do that checklist, fast enough to run while the timeline is still screaming. First, ask what kind of selling it was. Did the market slide like a slow argument, or did it drop like a trapdoor? Second, look for the footprints of leverage. If futures positioning and open interest start shrinking while price is still falling, that's not someone dumping. That's people being pulled out of trades. Third, compare the story to official behavior. If the rumor says China is unloading, but the most recent official gold data still points to steady accumulation, the rumor has a credibility problem. Try to think about this. Which is more likely in a 2-day crash, one country deciding to torch its own strategic hedge, or millions of leveraged positions learning what liquidity really costs? The first mechanism is simple, and that's why it's deadly. Volatility jumps, margin requirements rise, risk controls tighten, and the same people who felt smartest yesterday become the first forced sellers today. It's not personal, it's policy. The system doesn't hate you. It just doesn't need you. I've seen traders get the thesis right and still get wiped out, not because they were wrong, but because they arrived with the wrong amount of oxygen. Silver tends to take the hit harder because it is more like a narrow bridge than an 8-lane highway. When the crowd surges, the railings don't negotiate. Numbers get bent, then behavior gets bent, then the chart starts writing its own rules, and there's a cruel detail most people don't notice until the call comes in. Forced selling doesn't wait for your stop to make sense. It hits at the worst possible price, because the worst possible price is where the liquidity still exists. That's why you see vertical candles, gaps, and that sickening feeling of it can't be this cheap. It can. When brokers raise margin, they're not predicting the future, they're protecting themselves from your future. I'm not trying to scare you. I'm trying to name the predator. The predator is the loop, and loops don't care what the headline says. They only care how crowded the room is. Then the narrative shows up like a match near gasoline, not because it started the fire, but because it makes the fire easier to spread. One outlet framed the move as a wipeout in the trillions and called it a brutal lesson in liquidity. Another emphasized profit taking after a historic run, the kind of everyone lock-it-in moment that flips greed into exit velocity, and one of the more specific triggers floating around was a sudden shift in expectations around central bank leadership. Kevin Warsh's name hit the tape, and suddenly people were repricing the idea of stability. It's never just the person, it's the signal, uncertainty about the rules. Markets can stomach bad news, they choke on unclear rules. Now, slow down with me for 10 seconds. If you're holding a position, your pulse is probably doing math. Your mind keeps replaying the last green candle like it was a promise, and the scariest thought isn't what if I'm wrong? It's what if I'm right, but it doesn't matter today? I get that. I've felt that. Breathe once. Then we go back into the machinery. Because the second mechanism is the one that confuses people the most. A story can be true and still be irrelevant to the move. A policy rumor, a leadership rumor, a geopolitical rumor, sometimes it doesn't need to be accurate. It only needs to be usable. Usable means it gives everyone permission to do what they already wanted to do. Take profit, reduce risk, cut exposure, save face. Markets don't always sell because the future got worse. Sometimes they sell because the future stopped getting better in a straight line. 2 lines can hold the whole truth. They had a winning trade. Then the winning trade became crowded. That's when the exit turned into a weapon. And now we arrive at the China part, where the story flips if you look at what China can actually do. The gold angle is awkward for the dump narrative because the most recent official reporting, around early January 2026, still pointed to China extending its gold buying streak for 14 months in a row, not exactly the posture of a seller trying to crush the market. The silver angle is even more telling because the talk wasn't about Beijing flooding supply. It was about licensing and control an export regime that can decide who gets to ship refined silver abroad and when. That's not a dump truck, that's a valve, and valves don't need to crash prices to create leverage. They just need to exist. Try to think about this. If you were a state planner and you wanted leverage over solar, electronics, and defense-linked supply chains, would you burn your own inventory in public? Or would you quietly decide who gets access to the stream? That's why China weaponizes silver is a different story from China dump silver. One is a tantrum, the other is infrastructure. One is loud and temporary, the other is boring and permanent. I'm not saying Beijing controls everything. I'm saying the more strategic move is control, not chaos, and the market's worst habit is confusing the loud move with the powerful move. This is where the point of no return creeps in, and it has nothing to do with borders. When the price breaks, the human brain wants a culprit immediately because uncertainty feels like falling. China dump is the kind of culprit that fits in a caption, which means it fits in an algorithm, which means it spreads faster than any real verification. Retail gets dragged into it because retail trades headlines, not mechanisms. One expert even flagged warning signs that can keep silver weak after a crash, momentum fading, supply pressures, open interest slipping. You don't have to agree with every forecast to see the danger. When participation drops and positioning unwinds, the market can stay irrational longer than your nerves can stay funded. Here's the counterpoint, because reality is never one note. Could China sell through proxies, or could state-linked entities reduce exposure without making it obvious? Sure. Could large funds rotate out for reasons that have nothing to do with liquidity? Also yes. But if you want the highest probability explanation for a two-day air pocket, you start with the plumbing, you start with leverage and exits, you start with the fact that safe trades are often the most crowded trades, not because people are stupid, because people are human. They chase certainty. And certainty is the first thing that disappears. So now the real question isn't, did China dump? The real question is whether this was a flush and ugly clearing of leverage or the start of a deeper unwind where silver keeps bleeding as participation thins out. The next part is where we stop arguing with narratives and start tracking three signals that can be memmed away, and once you see them, you'll know whether this crash was a warning shot or the opening act. Most people stop at the crash and ask, who did it? I want you to go one step further and ask, what happens next when the story refuses to die? Because once a narrative gets attached to a violent candle, it doesn't fade when the price stabilizes. It mutates, it looks for a second target, a second panic, a second reason to trend, and the moment China dump becomes a habit, it starts shaping behavior. People front-run headlines instead of reading signals. So I'm going to give you three scenarios, and none of them require you to guess what Beijing feels. They only require you to watch what the market does when the adrenaline wears off. Scenario 1 is the cleanest. The leverage flush is mostly done, volatility cools, and the sell-off becomes a scar instead of a spiral. You'll recognize it because the market stops acting like it's being chased. Spreads tighten, intraday swings shrink, and futures participation stabilizes instead of bleeding out. It won't feel bullish. At first it'll feel boring, and boring is the first sign the forced sellers are gone. Scenario 2 is uglier, and it hides behind the word normalization. This is the deeper unwind where silver keeps leaking lower, not in one dramatic drop, but in a series of disappointing bounces. The reason is simple. After a crash, the crowd that provided momentum doesn't come back immediately. Liquidity returns in layers, and the riskiest layer is always last to rebuild. You'll see rallies that fail early, and you'll see sellers appear faster than buyers can organize. If you're wondering why this matters, it's because slow declines are where bad decisions breed people average down. People chase, people convince themselves the market owes them a rebound. Scenario 3 is the one that turns a market story into a geopolitical story. This is where the China weaponizes silver narrative stops being a meme and starts being a policy supply issue. Licensing and export gates don't have to ban anything. They only have to create friction. Friction means delays, selectivity, paperwork, and uncertainty for anyone downstream: manufacturers, refiners, even governments trying to plan industrial policy. And once industrial buyers feel uncertainty, they don't wait politely for clarity. They hoard, they pre-buy, they bid up premiums, and suddenly the physical market stops matching the paper market. Now, I want to slow down for a few seconds because this is where people usually sabotage themselves. When you're stressed, you stare at price and you stop thinking in probabilities. You start thinking in verdicts. It must rebound, or it's over, or someone knows something. I've made that mistake, and it's embarrassing because it feels like logic in the moment. What helps is turning the chaos into three signals you can check without emotion, like a pilot reading instruments through turbulence. Signal 1 is participation in the paper market, open interest, and how it behaves after the shock. If open interest keeps falling while price tries to bounce, that's not strength, that's exhaustion. It means the market is shrinking, and in a shrinking market, moves get exaggerated. If open interest steadies and starts to rebuild while volatility cools, that's a sign the market is returning to two-sided trade instead of one-way exits. This is where I keep it simple for myself. I don't need to predict the bottom. I need to know whether the crowd is still being pushed out the door. Signal 2 is China's official posture in gold because it's the quickest reality check against the loudest rumor. If the claim is China is dumping, then consistent reserve additions are an awkward contradiction. If reserve data flips and shows meaningful selling, that's when the conversation changes. Try to think about this. Which carries more weight, an anonymous viral headline or a recurring official data point that markets can track month after month? That single comparison won't give you certainty, but it will tell you whether you're chasing theater or tracking structure. Signal 3 is the export gate itself, how strict it is in real life, not how dramatic it sounds online. Licensing can exist on paper and still be loose, or it can exist and be tight enough to reshape trade flows. Watch for evidence that shipments concentrate into fewer approved firms, that delivery times lengthen, that industrial buyers talk about sourcing stress, or that regional premiums decouple from futures prices. If you see physical premiums rising while futures stay heavy, that's the market whispering two different stories at once. And when a market tells two stories, the next move is usually violent because it's trying to reconcile the mismatch. Here's a subtle but important counterpoint because I don't want you trapped in a single storyline. Even if China's policy adds leverage, it doesn't mean China caused the crash. The crash can still be the plumbing margin, positioning, crowding, while policy becomes the amplifier afterward. Those are different roles. One starts the fire, the other controls how quickly the smoke spreads. If you mix them up, you'll misread timing, and timing is where most people get hurt. One practical, legal-minded reminder before we'll end this plane. Treat market commentary as education, not instruction, and if you choose to act, respect your local regulations, your broker's rules, and your own risk limits, especially with leverage. That's not me dodging responsibility. It's me telling you the truth about what survives chaos, process, not bravado. So let's stitch the whole story together in one sentence you can actually use. The dramatic claim was China is dumping gold and silver. The mechanical truth is that liquidity dumped the crowded trade first, and then the narrative rushed in to explain the bruise. Gold and silver can be strategic, they can be emotional, they can be political, but in a forced unwind, they're just positions with an exit problem, and the more safe the crowd believes something is, the more shocking it looks when the crowd discovers the door is narrow. If you want the fast fact-check method, I'll make it painfully simple. Next time you see a China dump headline, run the 3 questions. Is this intentional selling or forced liquidation? What do positioning signals say? And what does official policy data actually show? If you want that turned into a 60-second checklist, you can screenshot, comment the word checklist, and I'll pin a clean version under the video. And if you've been here long enough to care about mechanisms over memes, subscribing isn't a favor to me, it's you choosing the kind of analysis you want more of.